In June 2026, the Magnificent Seven, Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, and Tesla, lost approximately $2.3 trillion in combined market value. That is not a typo. $2.3 trillion in a single month. The largest destruction of stock market value in history from a single group of companies. To put this number in context, $2.3 trillion is larger than the entire GDP of France. It is more than the total value of every company listed on the London Stock Exchange. It evaporated from 7 companies in 30 days. What caused this historic sell-off? The core question that investors are asking about every Magnificent Seven company right now is identical. These companies have spent hundreds of billions of dollars building AI infrastructure. When does that spending translate into proportional revenue and profit growth? The answer is not yet clear. And markets that priced in perfect AI execution at extraordinary valuations are now repricing the uncertainty. The split within the 7. Not all Magnificent Seven stocks fell equally. Nvidia maintained stronger performance than most. Its chips are the physical infrastructure of AI, and demand remains real. Tesla fell 8% in a single session, despite reporting strong delivery numbers, suggesting the market was already pricing in better results. Meta fell nearly 5% after announcing it might sell excess compute capacity, interpreted as a sign that AI infrastructure spending had been overdone. What this means for index fund investors. The Magnificent Seven at their peak represented a historically unprecedented concentration in major indexes. The S&P 500 at points in 2025 and 2026 had these 7 stocks, representing over 30% of its total value. A $2.3 trillion loss across 7 stocks is not contained within those 7 stocks. It pulls broad indexes down with it. The critical historical perspective. Every transformative technology in history, railways, electricity, automobiles, the internet, went through a phase where extraordinary early valuations were followed by a significant correction before the technology's genuine long-term value was established. The internet bubble saw Nasdaq fall 78% before recovering and eventually reaching new highs, driven by the actual businesses that survived. The question for AI is not whether the technology is real. It clearly is. The question is whether the valuations assigned to it in 2025 and 2026 correctly anticipated the timeline and distribution of that value. For long-term investors in diversified index funds, this is noise on a long journey. For investors who concentrated heavily in Magnificent Seven stocks at peak valuations, this is a real and painful lesson in the risk of concentration and the importance of diversification.